Thanks, Tumi, for that very interesting and great overview of our current economic climate. So I'm going to now just talk a little bit more specifically on the markets, what's actually happened, as well as get into the exchange funds performance and a couple of our trades that we've recently done. So I thought a good part to kick off with was actually just a few reflections, and that is when we are looking at funds, fund management, performance, and implementing one's house view, it is always important, I think, just to remember three key things. First of all, facts can change and things can change very quickly. So the environment, if you listen to Tumi now, really is fluid. There's lots on the go. And as fund managers and implementing one's house view, you need to, I think, be flexible and open to making changes quite quickly in terms of your house view and positioning. And in terms of that, it's great to have a team-based approach, people you can talk to, people you can bounce ideas off and discuss possible changes in the environment and how you want to implement that within your particular portfolios. And then, of course, what is vital is just a repeatable and robust investment process. And I think within our exchange solution funds, we have had a robust investment process since these funds launched 18 years ago now. These are, I think, the second longest running range of funds in the country with a pretty good long-term track record. I thought this was a really great slide, which one of my other colleagues in the team, Sinead Villiers, put together, and it really looks at six past economic events, looking back the last 25 years or so. And you'll see, starting on the left-hand side, we have the emerging market or Russian crisis in 1998, the tech bubble in 2002, the global financial crisis in 2008, and the COVID collapse in 2020, and then our last debacle that we've been looking at really this year with the conflict in Ukraine and rising oil prices. And what you'll see is we've set all the starting periods at 100, at what the markets were at those particular levels. And then when the crises broke out, the brown column shows you how much markets fell over those periods. And you'll see, for example, during the Russian crisis, 43%, tech bubble 36, global financial crisis 57, etc. So we show you quite marked and material falls in the market. But the key point in the takeout is actually the light green column on the right-hand side, which is the recovery in the markets. And we've put in the block there how quickly it happened. So again, just looking at the Russian crisis, we started at a particular level, markets fell by 43%, we landed up at 57 level, and within 15 months, we were up and back at 120. So 20% higher than the starting original point and almost 100% plus higher than where markets were at their low point of 57. And it's very, very similar situations for all the other cycles. Within 3 years or less, markets have recovered very quickly. And I think the takeout point in this is it's very often when periods are at their most anxious and strain, and when it counters all your emotions to perhaps increase your equity exposure or increase risk exposure within your portfolios, that is when you probably need to do it, because markets do recover and they can recover very quickly. This slide here sets out both the South African and the global markets over the COVID crisis. So if we start in South African market, and we have shown you the slide, but we've just updated it now because I think it's quite an interesting one, is we look at the South African stock market on the left-hand side. You'll see it was ticking along, then COVID struck and markets fell 33% by March 2020. But how have they recovered since then? And it talks very much to the previous slide that we've just spoken through. You'll see markets recovered strongly and quickly. And basically, since the low of the market in 2020, March, markets are up now 93%. And overall, markets are at a 30% higher level than what they were pre the COVID crisis. Just interesting to note, year to date, markets are currently sitting down -6%, South African markets. On the right-hand side, we have the offshore world index measured in dollars. Similar type of a story. Markets fell 32% in March 2020, and since then they recovered 70% and are 16% higher than what they were pre-COVID. Year to date, however, we see global markets in dollars are down 18% year to date. So global markets, global equities have taken more pain than the South African equity market. Now we see this in the actual numbers. So this table sets out the actual returns across all the asset classes as at the 31st of August, so a few weeks ago. And we really just see, if we focus really on the column that I've highlighted here in the green, year-to-date numbers. And I think importantly, if we look at that, the equities, South African equities are down 5-6%, properties down 10%, bonds are flat and cash is up by about 3%. But equally on the global side, measured in rands, the very bottom is measured in dollars. So let's look at it in rands, but in rands, global equities are down about 12%, listed properties down 14%, and bonds down a massive 10%. That's the highest bond for global fixed income in about 40 years that they've undertaken such large capital drawdowns. So all asset classes, as one can see, have taken pain over the year to date because of this global energy crisis and the conflict in Ukraine and Russia. If we look at the one-year numbers, a little bit better, still nothing great. South African markets marginally in the positive territory. How is this translated really into the Exchange Solution Fund of Funds and performance? So you'll see there year to date, and my next slide actually puts it, I think, quite nicely into perspective. So year to date, the funds are all marginally down. Over 1 year, we're still in positive territory, as well as 2 years and the longer periods. I think really just the key takeouts on this slide is that if we look at the 1 year and 2 year numbers of the exchange solution funds across guarded, diversified and accelerated, all the funds are ahead of the peer group quite nicely and have had 2 very solid, strong years of performance-wise relative to the peer group. That was after a period about 3 years ago when on our domestic equity side, we were struggling. We made quite major changes to the equity holdings within the exchange funds about 2.5 years ago that have all paid off very nicely. Equally importantly, I think, is the long-term numbers, the 10-year and the inception numbers. As I've mentioned, inception is going back to September 2004. And over the long term, the funds have delivered ahead of the peer group and quite nice, strong, positive annual returns. And particularly if we look over the long term, since inception, the funds have delivered, the guarded fund has delivered a real return of about 3.8% ahead of inflation, which is just ahead of its objective of inflation +3. The diversified fund is marginally behind the inflation +5 number and accelerated also in quite strong positive territory. Year to date, I think this is quite an interesting slide and does help put things into perspective. We've sort of categorized things here into what I would call growth assets, preservation assets, and then on the right-hand side are the exchange solution funds. So on the left-hand side under growth assets, we've got South African equities and South African property, as well as global equity and global property shown in rand terms. And year to date, you'll see all 4 of those risk asset classes where one generally is relying on for strong growth and strong positive real returns. All of them have performed negatively because of the issues that Tumi mentioned about, economic update, and down between 6 and 14% respectively. In terms of South African bonds, cash and global bonds and cash as measured in rands, you'll see there also bonds marginally positive for both for South Africa. Cash also slightly positive. As I mentioned, global bonds materially down, and South African, well, cash as measured in rands is up 7.9%, largely due on rand weakness. So again, a mix of negative and positive returns on that fixed income and cash part. We've put in there inflation around 7.8% as measured of last month, and you can see really, barring offshore cash due to rand weakness, no asset class has come close to matching inflation, let alone beating inflation and giving you real positive returns year to date. So this, of course, makes it very difficult to achieve positive returns, let alone inflation beating returns, because these are really all of the building blocks that we've got to work with in terms of trying to produce returns. And we've set there the guarded, diversified, and accelerated fund performance year to date, down 1.5%, 2%, and 2.5%. So I think relatively we saw versus the peer group, we've managed to do quite nicely and outperform most of the peers. But equally, I think we've done a pretty good job in trying to preserve capital in times when most asset classes, particularly the risk on asset classes, have all lost a large degree of capital. This just sets out the exchange fund performance relative to a few of the key peer groups and competitors. I'm not going to go into it in detail. I know just in terms of wealth planners and some of you guys invested in the funds, you're interested just to know how the funds have done to some of the other key large well-known brands out there. So you'll see we've put the 1 and 2 year numbers in on the guarded fund on the left-hand side, diversified fund on the right-hand side, to some of the other key big players like Coronation, like 91, the Ned Group funds, and who else? We've got Ford in there as well. And I think if you compare the exchange guarded and diversified funds to some of these key competitors, one can see that we've certainly held our own and performed up there with them all, if not ahead of some of these very well-known and well-used funds. In terms of our house view, how are we currently positioned? And I guess talks also a little bit to some of Tumi's points. So to summarize it, in terms of equities, domestic equities, we are currently overweight, as well as bonds, we are materially overweight on neutral positions. Local property, we neutral, and then offshore, where we have been for a while, we are underweight at the moment. We still have quite significant offshore and foreign equity exposure, but relative to our neutral positions, we have reduced our exposures over the last year or so and are currently sitting underweight. The one area where we have increased our exposure just about a month or so ago is on our Africa bond fund. You'll see there that's at about between 3.3 and 3.5%. So overall, still overweight domestic assets, underweight global assets, and slightly overweight also on our Africa bond holding. Two of our trades that we've recently done within the exchange funds that I think talk quite nicely to the active management within them, and they are just two examples of many trades that we have done over the course of the last year or so, but these are our two most recent ones done in the last couple of months. The one was done on our global equity allocation. Within our global equity allocation, you'll see originally we had exposure to the four funds shown on the left. However, with the changing dynamics in global markets, the war in Ukraine, potential recession or slowdown in economic growth happening, we thought we would reduce some of our exposures to the more value type of equity managers and increase towards quality holdings. We thought quality type of manager holding quality equity stocks would stand up better in times of economic slowdown and recession. So we introduced the 91 Global Franchise Fund with an 8% weight within our offshore equity holdings, and we hold that, and we reduced our exposures to some of the other managers, particularly the Dodge & Cox Fund, which was more a value type of approach, which has been, as you can see, one of our biggest holdings and it's performed really, really well. So we have slowly started to adjust our offshore global equity mix. The other trade that we did, as I've just alluded to in my previous slide, was on the Africa Bond Fund. So this is actually a US dollar denominated fund, but you invest via a rand feeder. It gives you dollar income. And currently we are invested about 3.5% in this fund, having increased our weighting from about 2% up to that 3.5%. You'll see on the right-hand side, the yields on the offshore, on the Africa bond is sitting high, sitting at yields of around about 13% or so, and they've strongly gone up. The red line on that graph, you'll see it's really peaked. So we feel that these yields have overshot, that they are pricing in too much risks, and that these yields will start coming down back to the levels that they probably should fairly reflect. Hence, we've got into the fund, and as it happened, whether it was by skill or luck, since we've gone into the fund's really, which has just been for about a month or so, the fund was up 10% for the month of August. So that was quite a nice little trade within the portfolios. So I think those are just two examples of the types of things that we do within the funds, constantly based on valuations and market conditions. These are 6 of our core holdings. You're all well aware of them. We hold some other fund managers as well, but I think these are 6 of our core holdings: Taquanta, Coronation, Marzi on the equity side, 91, as I've mentioned. We've just introduced the Global Franchise Fund, Sesfikile on listed property, and M&G on local domestic equities. So that's all really that I wanted to say and that we've got time for in terms of the exchange funds. I think overall, to summarize, we've had a good run with the funds. We are actively managing them. This is a really important range for us, and it takes a lot of our time, and attention is still given to this range. And we thank all of you for your continued investment and support within the exchange solution funds. So that brings us to the end of that. What I would like to do is just introduce our next speaker, and that is going to be Melanie Stockett from Laurium. She is one of the senior portfolio managers there. She specializes specifically in the fixed income asset class, and she's going to be speaking to us today a little bit about Laurium's current views on fixed income, and she's going to provide some insights into that particular asset class. So I shall hand over now to Melanie.